Michael Burry says, sell. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, famed hedge fund manager Michael Burry is calling for an epic .com style crash for the markets. Now, of course, we're no stranger to Michael Burry's calls, who's been saying for quite a while that the markets are going to crash. But now we're going to look at why he's saying it may be coming sooner than you think. Plus, there's an anomaly in the unemployment data, and the Treasury market's doing something it hasn't done since the 1980s, and that's not a good sign. Let's over to Markets Insider, where we picked today's story up with the headline, Big Short investor Michael Burry compares the stock market's rally to the .com bubble and hints he's bracing for an epic crash. The investor of the Big Short fame tweeted in a chart on Tuesday, which we're going to look at in more detail, that showed the S&P 500's roughly 40% plunge between February 2001 and October 2002. It also plotted the decline of the Federal Reserve's benchmark interest rate from 6% to below 2% during that period. This time he's different, Burry wrote, likely mocking commentators who see the latest market rally as sustainable. And you're hearing that in the news. You're hearing a lot of people say we're at the beginning of a new bull market. Stocks are going to go to new all-time highs and continue to run. And while they can go to new all-time highs, what Burry's suggesting is that is going to end in a spectacular way, just like the .com bubble ended when it burst and stocks went plunging lower. Now let's take a look at the charts and see why he's making that case. Here you can see we're going to use the Wilshire 5000, the total U.S. stock market, instead of the S&P 500. They're very similar. So we're also going to overlay in the federal fund rate in red. And what he's kind of pointing out is that in periods where the fund rate pauses. So here we see the Fed pausing, and what happens, you can see stocks rally, just like we're seeing now as the market is starting to price in and believe the Fed is far closer to ending their rate hike cycle than they believe. But look what then happens. Stocks then start to head lower, and the Fed cuts, and then you see the market head much lower. And of course, the prevailing view is if the Fed cuts rates, the markets go higher. But now let's move forward to the great financial crisis and see what happened then. Here we can see in a similar fashion, the Fed entered a pause on its rate hike cycle. Stocks went on to make new all-time highs. The Fed started to cut. This is what everyone believes now will be the beginning of the next bull market, but instead the economy went the other way. The Fed was forced to cut, and stocks went plunging lower. And we can even move forward now into 2019 to 2020. We see the Fed pause to put kind of a ceiling on stocks. They did briefly make new all-time highs. The Fed cut. Everybody loved it. They said, this is it, beginning of a new bull market. And then what happened? Stocks went crashing into the pandemic. Of course, we can note that we were likely to see a global recession at that point anyways. But you can note the Fed tends to follow the market lower, not the other way around. Higher rates encourage savings instead of spending and investing and make borrowing more expensive, which can relieve upward pressure on prices. Yet they also dampen demand, which can erode corporate profits, pull down asset prices, and temper economic growth, lifting the risk of recession. And of course, that is the prevailing view of what high interest rates do. But of course, what we need to understand, what a lot of people miss, is that in a growing economy, in an expanding economy, rates should rise as a function of a demand for money. As people look to invest money and make a bigger return on their money, banks and other depository institutions say, look, we have to raise rates to attract money into our banking system. And that's why we should see higher rates during economic prosperity. What we shouldn't be seeing is higher rates in a period where the economy is slowing. That's the mistake the Fed's making here, is they're raising rates into what we already know and we'll look at here soon is a slowing U.S. economy. Burry's latest chart and comments suggest he sees shades of the stock market surge in the early 2001 when rates were nearly 6%. He seems to expect both the S&P 500 and the federal funds rate to eventually tumble. I think he's right on this, as they did during the dot-com crash. with the Fed cutting rates as the economy weakens and asset prices slump. And of course, you start to think about why this happens and why it happens over and over again. Because when you're in a debt-based economy, as we've been talking about in the last two shows, that you need a constant and regular expansion of debt. But when you slow that debt creation down and wages aren't keeping up with it and consumers don't have the ability to make payments on those debts, you get a bubble that bursts, and that's what we're seeing form all over again. And here's Burry's claim of why, of course, we're going to see a crash, because the prevailing view among many experts is the Fed's nowhere near done hiking rates, that they need to get to 5 or maybe 6% to tame what is some of the highest inflation we've seen in decades. Here you can see 6% on the federal funds rate at the yellow bar here, or line on the horizon. And we can note that the last time we saw that was in the 2000s before the market crash. Burry's saying, look, if you look at what happened then, it's about to happen all over again. The Cyan Asset Management chief has been pounding the alarm on stocks this year. He shared a similar chart in January, circling in red the S&P 500's rally between September 2001 and March 2002 before it bottomed 6 months later. He also tweeted a single word of advice to investors: sell. So what he's suggesting here is kind of what the case we've been making is there can and likely will be another rally in stocks, but when that comes to an end, what we're going to see is the economy start to slow down in a big way, the Fed start to cut rates, and then you're going to see stocks go plunging straight down. And that's what Burry's saying here is stop buying at the top. You need to sell at the top and, well, buy at the bottom. Notably, Burry emphasized in October that he's bracing for a collapse in stocks that dwarfs the dot-com crash, suggesting that they're going to be dirt cheap as there's so much money parked in index funds today. The difference between now and 2000 is passive investing bubble that inflated steadily over the last decade, he tweeted at the time. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and the door is only so big. And he has an excellent point of how this is going to play out. And what he's suggesting here, what he's trying to tell you, is that in an index fund, most of the money is going into the top 5 or 10 companies. So when people see markets go down and they start selling, well, guess what? Everyone's going to be selling the same stocks. There's going to be no buyers, and that is going to drive stocks in what could be a generationally low buying opportunity. But if there's one tool that you could use to help you, and of course it's worked really well, as many of subscribers know, and that is CTA Timer Pro, suggesting in his long positions that the market's going to go higher. We see in the short term, the bond market actually went down. The machines would be likely following that based on our historical model. But if you want to know, and you've seen this report, those of our subscribers know it called the rallying goal long before anyone else. It's been suggesting you should be long stocks, and guess what it's going to do when it's time to turn? It's going to tell you when to sell as well. There's still a coupon code for $10 off the new price of $30. Grab it while you can. The U.S. jobless claims pick up for the first time in 6 weeks as now we look to the other side of Burry's claim here that we can actually see a material increase in the equity markets before things get worse. Because if there's one thing you should be watching, it's the weekly labor market data, because it's going to tell you when you need to get out. And we go back and look here, the applications for unemployment benefits rose to 196,000. The 4-week average fell to 189,250. What we can see is the initial claims up 13,000, the continuing claims up 38,000. But look at this, when you take into account, this is the anomaly I kind of mentioned at the beginning of the show, what you see when you take in all benefits, all programs, a 52,000 jump. And guess what? That's coming out of the state of California. I don't know what's going on there, but something is changing in the big state of California that could have repercussions to the rest of the country. Maybe this is a sign that all those tech workers are finally starting to file some claims. I don't know. We'll see soon enough as we get more data. And now we go back to those same charts we looked at before, and here's the key. You note, going back to the dot-com bubble, we see stocks rallying up, not making new all-time highs, but look what then happened. We saw an increase in the 4-week moving average initial claims. That suggested the economy was in dire shape after all, and stocks reacted negatively as they should. Fast forward to the great financial crisis, we see new all-time highs in the market as unemployment claims remain low. As they take off, stocks head lower. Watch for that as well to happen again. And that's the risk we see here, is the labor market is not giving us the flag that we need to see for that risk off moment. In the meantime, as long as those initial claims stay low, it's risk on and big way to the upside. And now let's take a look at the bond market, who's giving us a signal of something we haven't seen since the 1980s that validates that Burry's right and that everything is about to come unwinding in the near future. Treasury yield curve inversion reaches the deepest level since the 1980s. They typically come about when central banks are in the process of raising policy rates, a maneuver that pushes up the short-term yields while weighing on long-term yields by dampening expectations, as we said repeatedly on this show, for inflation and growth. In the U.S., they have a track record of preceding economic downturns by 12 to 18 months. Let's take a look at this chart here. We now have the Wilshire 5000, the federal funds rate, that is in green. Here's the yield curve in red. Because it gets squished down, I've noted here's the inversion below the yellow line. And what happens is you see stock market goes up and tries to make new all-time highs. The Fed pauses, the yield curve starts to steepen, unemployment claims then follow, and next thing you know, everything comes unwinding. Move forward to the great financial crisis. What do you see again? The Fed, of course, has already paused, starting to cut. Everyone thinks that's the best thing ever. The bond market says not a chance. The yield curve steepens. We note unemployment claims then go higher, and the whole thing comes unwound. And so what Burry's telling you is, look, if you're piled into this rally, maybe you ought to ride it for a little bit longer, but there is a point you need to sell, because when the economy starts to unwind, when the unemployment claims rise, when the yield curve steepens, it will be likely too late, as everyone is going to be selling the same stocks. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.